Australia is opening up. They're looking to do travel bubbles with Singapore. Vietnam is also opening up. Maybe they are feeling the fear of missing out when they see Bangkok and Malaysia all looking to open up already. And last but not least, New York is also opening up way later than most other American states. I believe that travel will be bigger than most expect in 2022, and this company is a king of service apartments. Its properties in all of these three places, and it is a subsidiary of CapitaLand. Take a guess who is it, because this is my early pick for best dividend company in 2022. Hi guys, welcome back. This company is Ascot Trust. Ascot Trust actually owns brands such as Ascot, which you have seen before, and Citadines. And I'll go through a quick overview with you before giving you real numbers for you to crunch to. To start things with, Ascot Trust right now is actually a merger between Ascot Residential Trust and Ascendas Hospitality Trust, and that merger actually took place in end of 2019. That's why if you look in terms of 5-year numbers, those reflected over there are not necessarily accurate because a lot of it is before the merger itself. Looking at the overall trend, it looks to be fairly stable and growing at a moderate pace. As a big picture overview, Ascot's brand is really strong in service apartments. You realize that service apartments, everybody staying there is on a longer lease. It's not like a hotel whereby you go 1 night or 2 nights. Service apartments usually cater for tourists or businessmen that are looking to stay like a week or even a month. The average length a customer stays with them right now is 3 months. And how they actually run their business is actually using two models. The first is actually a master leasing contract. And what can we understand from master lease is that they actually own the place, but someone else or another brand is actually running the day-to-day ops. In terms of Australia, the master lease actually has an annual indexation, which means it increases every year. And in most parts of Asia, a master lease will include a variable component as well as a fixed rent. So that fixed rent was actually very useful for Ascot to survive this whole pandemic because they had a guaranteed amount coming in. So using the Australian one as an example, this is a recent acquisition they made. Quest Macquarie Park. And Quest is actually a hospitality brand themselves. So they actually take a master lease from Ascot. And they pay Ascot while running day-to-day ops. This acquisition has a yield of about 5%. The second method that Ascot actually makes money is through management contracts. And they have also two kinds of management contracts. The first is a management contract with minimum guarantee. That mainly applies for their properties in Belgium, Spain, and UK. This minimum guarantee was also very useful in keeping this business alive because when COVID-19 caused lockdowns, at least there was some income. But the main part that I'd like to focus for us today is actually in management contracts without minimum guarantee income. This applies to most of its properties in Australia, China, Indonesia, Malaysia, Philippines, Singapore, and mainly US and Vietnam. In my opinion, this has the biggest upside because it's fully variable, correct? And if you look at the latest first half 2021 numbers, it looks as if this management contracts segment is very small and that Ascot Trust is actually a very stable business. It is actually not true. This pie is skewed because a lot of variable income it can make from management contracts was not earned because of COVID-19. That's why the best way to understand it is to look back at fourth quarter 2019 numbers and you realize a totally different picture. I'm using this as a basis because I'm projecting the business a few years ahead to see where it looks like with COVID-19 fully as an endemic state. So we realize that management contracts is actually the growth mechanism behind this hospitality trust itself. In fact, 20% of it is going to come from US and Vietnam is the third highest, holding 9%. So just now I mentioned that New York is opening, correct? And these three properties they have in US are very important. These three have been impacted and moving forward, I expect them to deliver results. And if we see the third quarter 2021 latest results, you realize that the revenue per room for the US segment has actually surged up quite considerably. So if we look back in terms of numbers, we see that fourth quarter 2019, management contracts already delivered $40.7 million in gross profits. And if you adjust it to what we are seeing right now, there's a big room for this amount to grow. The bottom part again is first half of 2021 and it only clocked $31.4 million. In the next segment, I'll show you the strategic direction of Ascot Trust and answer what are risks when you invest into this company itself. And before I get there, invite you to smash the like button early because it's taken our team hours to prepare this presentation for you. And again, if you like discussions on local businesses, local stocks, smash the subscribe button. The white elephant in the room that I'd like to address head on is this concern over here. You know, Ascot does a lot of corporate travel, correct? And if you do some research, you realize that some CEOs have commented that business travel may be gone for good. Some companies like Volkswagen are also making their employees jump through hoops before they can fly, and they even have to justify why they can't conduct the business online. Locally listed bank UOB is also cutting its travel budget by as much as 50%. So if corporate travel is going to be weak for the foreseeable future, what are chances that Ascot Trust can recover back to pre-pandemic state? That is a $1 million question that nobody can answer. My gut feeling is we are overly pessimistic on things, and there's a good chance that they can deliver something that's above expectation. That comes from my faith in CapitaLand's management. If you look at the track record on how they have run this whole REIT itself, you realize that they've grown the portfolio consistently, and the merger with Ascendas Hospitality Trust was a good business decision. As of right now, management is moving towards two key segments: rental housing, in which we can see from these acquisitions in Japan and USA, as well as student accommodation. In this quick snapshot, you'll see that rental housing properties have increased from 11 to 14, and student accommodation is a new lodging asset class that they are inputting for presentations nowadays. In addition to that, it's been communicated before that rental and student housing will be grown to 15 to 20% of the portfolio to give it even more stability moving forward and to diversify away from service apartments. CapitaLand themselves have a pipeline of multi-family assets that they can potentially inject into this REIT itself. And when you buy a REIT, you are relying a lot on the sponsor to give the whole REIT itself new acquisitions to increase the dividends per unit. And just in case you're thinking if Ascot Trust has funds to make acquisitions, current net gearing is only 35.9%, and that they've declared they have 1.17 billion worth of available funds, simply because they've divested some assets in the last 1 or 2 years. So if what I say were to come true, what can we expect from Ascot Trust? If we look back at some of the reports when Ascot was merging with Ascendas Hospitality Trust, it was mentioned that the DPU then was projected to be 7.34 cents, and that NAV was $1.22 per unit. Right now, at this point of filming, Ascot Trust is trading about $1, which means it's pretty much below its NAV. And if they can recover 90% of DPU, that could easily look like 6 cents per unit, which is pretty good if purchasing price is $1. Not only that, Ascot Trust has actually traded at a premium to its NAV before at certain periods of time. And I believe that when travel is running full force again, there's a good chance that market will overpay for such an asset. So what do you think? Leave your thoughts in the comment sections below. I'll be keen to hear from you also. And since you stayed to the end of the video, I've actually a bonus point to add further. Why not buy a travel tech company like Booking.com? Wouldn't it be better? Asset light, and then you can see it as a growth company. I did consider it strongly before making this suggestion for you. Let me pull up the chart for Booking Holdings. You realize firstly that in 2016 to 2019, share price was relatively flat, correct? And actually Booking.com, we know it is good. We know that it's very dominant. But what has changed that much over the last few years? Not much, correct? But why do we need to pay a premium of about 20% over what is valued before the pandemic? To me, that doesn't make sense, correct? Travel is not fully recovered yet, and yet we have to pay a premium valuation in comparison to pre-pandemic. That's why it got me thinking, are we just paying a premium for a tech company with no reason? And with that, I'll much rather buy a REIT whereby the properties are sound, management is competent, and then I can sleep properly knowing that they can deliver dividends for me. So hopefully this presentation helped you. Again, we invite you to smash the like button. And if you're looking for more REIT ideas, I've actually covered before on Suntec REIT, which has convention centers, which may benefit with travel, as well as Mapletree Commercial Trust, which owns Vivo City itself. So with that, I'll sign off and see you in any of these tutorials. With that, take care and goodbye.